The key point here is that you want to find a card that fits your spending. You don't want to fit your spending to the card you want.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, Nathaniel Leach and Dan Weiss. And today, we're going to talk about credit cards. And I'm so excited to talk about credit cards as we have two of our favorite guests, you guessed it, Dan Weiss and Nathaniel Leach, to really lead us through this. Dan has an extensive banking history, so he definitely has some answers to the questions I'm going to propose. And we have our own The Points guy, Nathaniel Leach, who loves himself some credit cards. So we're going to ask him some questions about who are the best rewards and how do you find that and how do you track it? So overall, we're going to get started and this will be a fun one. Dan, I'm going to start with you. And we need to get the basics. We need to understand how credit cards work, credit score, all that fun stuff. So, can you please tell me about the FICO Formula? FICO Formula. I apologize. No, FICO. FICO. Hit it.
I'd be happy to talk about the FICO Formula, and I love this subject matter. A lot of times, depending on the different conversations, either Nathaniel or I or both of us are having a conversation with clients about this topic. And Nathaniel and I actually use our own personal credit cards very differently, but they work for both of us the way that we use it, which is kind of why this conversation makes a lot of sense to have, because it's not one size fits all. And we're going to talk about the mentality behind that. But Tim, good idea. Let's start with just some of the basics, starting with the credit score itself, the FICO score. So there's a formula that comes into play here that is really important to understand. I think it alleviates a lot of confusion when it comes to people's credit. Here's the breakdown of that formula. 35% of your credit score is dependent on making your payments on time and in full. It's followed by what's called capacity. Now that makes up 30% of your score. This one is a little bit different and maybe perhaps slightly backwards to think about. Here's how capacity, what it basically is and how it works. So capacity is the bandwidth that you have when you take all of your credit cards, all of your credit really, right? And you aggregate it together and you say, okay, this is how much I possibly could spend. Now bear with me real quick. Let me give you an example of this. Let's say, for example, you have two credit cards. One at a $10,000 limit and another one at a $10,000 limit. And you never use one. It's just kind of out there. But the other one you use, right? Let's say that you use it. Typically, you might spend $5,000 on that. So 5,000 out of the 10. But really, it's 5,000 out of 20 because the bureaus are going to look at both those cards together. That means that you are utilizing 25% of your credit. Now, if that one that you don't use wasn't around, you canceled it, whatever be the case, well, now your total limit is 10,000, meaning you're using 50% of your capacity. Not as good, according to the bureaus. You're actually going to get dinged on that relative to the first example. And it's not just credit cards. For example, if you have a revolving line like a HELOC, a home equity line of credit, we've spoken about that topic before. That's like a giant credit card, but it's secured, right? Attached to your home. That's going to get added in too. So it's really that overall revolving line of credit that you have and how much you're utilizing compared to what the capacity is. Now, you might be saying, ooh, this is weird. Why would your score actually be better to have greater capacity? Yeah, I agree. The bureau is not human. So a human might say, yeah, that's weird because can't that person just go out there and spend more money and wreak more havoc? The answer is absolutely yes, they can. It's not how the bureau thinks about things. The bureau takes a look at it and says, okay, what we're looking at is how long is it going to take for this person to default on their loans? And if you've got more room to charge things, you got more time before you default. It's that simple. That's credit capacity, 30% of your score. Moving on, 15% of your score is going to be attributed to the length of your credit history. So going back to the other example about capacity, if that card you never use doesn't have a fee associated, don't close it. You want to be able to have long lines of credit. So if you got a card when you were 18 years old, but you never use it, don't care, don't cancel it. You want those lengths to be in place, 15% of your score, right? Next, new credit. This one also is confusing. 10% of your score is based on new credit. You go out, you get a mortgage, credit's going to take a ding. I go out, shop for a car, I'm going to have an inquiry, right, on my credit report. Someone pulled my credit, boom, credit's going to go down.
For our listeners, when it comes to inquiries, could you explain the difference between a hard inquiry and a soft inquiry and what the difference is?
Yeah, so one of which, a lot of times it's based on usage. So if you are, for example, opening up a new bank account, they're probably going to pull your credit. The bank is determining whether or not they see you as a risk, but you're not applying for credit. So it's going to be considered a soft inquiry. It's not going to ding your score at all. It's just them checking. A hard inquiry is going to come into play if you're actually applying for debt, for a loan. Then the bank's going to pull that. It reports differently. It will impact your score. However, there's a myth on that, and I'd like to come back to that actually. But that's the difference between soft and hard hit.
Thank you. Yes, come back to the myth. I'm excited to talk about the myths.
Absolutely. Myths are fun, right? We see a lot of these today in other subject matters too. So the last piece of your score is going to be credit mix, 10% again. That's the full formula. Credit mix is the different kinds of credit that you might have, of which some might be secured credit, some might be unsecured credit, meaning that it either has collateral attached to it, right? Something that people can take if you don't pay, or no collateral, right? It's just your promise to pay. That's riskier.
Awesome. So we have a good understanding of the FICO score or how the formula really works. When and how does someone establish credit? And I ask this because some people are so debt adverse that they're scared to open up credit cards because they don't want to necessarily spend too much. They may be a spendthrift. Somebody who promotes little credit is like Dave Ramsey, for example, talks a lot about, getting rid of credit cards. So can you tell me about just like the importance of credit and how and when I should establish it?
Yeah. So this was actually a personal battle for me for a long time. Growing up in the financial means that I grew up within, I was terrified of credit because I was terrified of debt and the struggles that I had dealt with that as a child. So I was really afraid to touch any kind of credit. I finally did get a card when I got to, I was an upperclassman in college. So somewhere around then, and that's when I started establishing credit. And I did so because I just came to the realization that someday if I wanted to buy a house, it's going to take me a very long time to get cash on hand to be able to do that, right? Not to mention it's maybe not a great idea in general, but that was the way I was looking at it. So I think that it's that there's an importance to do so because not only are there mortgages, homes that are going to take credit to be able to buy, but employers are now looking for credit, right? They want to make sure that they're looking at it as a way, can I trust this person? Have they been responsible, for example? So there are other people that might look at credit as well, where I think it's a good tell of, can you handle your finances? And it's a good tell from an organization standpoint. There are ways to do this that perhaps I didn't take advantage of, but I'm sure going to encourage to my daughter. So we put out an Instagram post, I believe, maybe on Friday or Thursday of this past week, and it talked about putting your child on as an authorized user on your card. Doesn't mean you have to tell the child that, right, or give them the card, but doing so would help establish their credit earlier on. Student loans is usually how a lot of kids start picking up credit because they have to take those loans out. So there is a benefit in establishing it as early as possible, but you've got to weigh that out with what is the responsibility of that child. If they have access to it, is it worth it? Is their brain and maturity level really ready to do so? And a lot of times it's hard for them to establish credit on their own, which is why, for example, doing so and making someone an authorized user is helpful. A lot of times we find that 18-year-olds coming out the gates, credit cards companies that they don't want to touch those people because they're unknown, and unknown, as we know, is perhaps the scariest of risks. So in all reality, there are ways to still tackle that. There are things called secure cards that banks will offer where you can put down money, and now you've collateralized, because there's something the bank can take, an unsecured debt. So if the child doesn't pay on the card, bank's going to take their money, right? So they're not the most rewarding cards. There's no question about that, but they get the job done of at least establishing the beginning of credit.
And just a follow-up question on the credit score. So, let's say that I am not in debt. I have some good cash on hand, but I don't have a credit score because I've been so debt adverse. Paid through my school, no car loan, haven't had a mortgage because I'm renting, but I want to get a house. If I don't have good credit, right, and I need to build it, do I really need to do that? And if so, could you give us an idea of what the interest rate difference would look like? Because, right, correct. If you have better credit score, the bank theoretically should give you a better interest rate because you're a little bit more secure relative to somebody who's maybe more risky.
Yeah, I think that's a very valid subject matter to talk about. You're right. So what's going to end up happening is the bank is going to charge you more, and those rates are going to depend on the time, right? But for example, if today a mortgage rate on 30 years unbelievably offered at 2.75%, that's for top credit. That's for what's known as A credit. Now, A credit is subjective based on the lending institution, but in any institution I could think of, it's going to be 700, if not 720, and in some cases even 740 or higher. That's more uncommon. Really, kind of 720, I feel, has been the more common standard. If you're below that 700, though, you're not A credit. And that means that you're going to get downgraded that rate situation because the bank is not as comfortable. Either you damage the credit or you don't have the credit to establish the A category. And you're going to end up paying likely a few extra percentage points over the life of that loan, which, depending on the size of the loan, is likely going to cost you a lot more money. It's simply
Awesome.
by just changing that piece, by getting that credit early and being responsible, it saves you a ton of cash.
So then I have a follow-up. To Tim's earlier part of that question, though, does it make sense to kind of game the system in a sense? Like, for example, if you have saved up enough money to buy a car, does it then make sense with the concept of having a mix of credit to get a loan and then pay a few payments and then pay it off completely, so that you can have that mix of credit involved, or to have a one credit card with no annual fee and you pay that sucker off every single week or every single day if that's what makes you happy. Maybe you just use it once a year or once every month to establish some credit activity. Does it make sense? Is it possible to do that? Hence, because just by taking on those kinds of debts and then quickly paying them down, I assume that it would be worth the risk because of the potential amount of interest saved if you were to go for that big mortgage.
Yeah, it's a good question, Nathaniel. So it might make sense. I don't know if the car one does or not, right? It depends, I guess, on how much interest we're going to pay. Now, we're really talking about two different objectives there, but it could. The credit card, if you pay it off on time, I think that definitely makes sense. And I'm glad you brought up that point. So if you pay off your credit card within that billing cycle, you're not going to see any minimum payment required, and you're not going to have any fees to pay as far as interest is concerned. Only charges you if you don't pay it off in time. So there's no disadvantage in doing that. The one thing you have to be careful of, right, is if you're starting out, kind of like with what we've been talking about lately, you're not going to get a big line of credit, right? Because the bank, the larger the line, the bigger the lending institution, the bigger risk they're going to take on you. So you're probably looking at a smaller limit, maybe $250, maybe it's $500. So there's something else you got to be concerned about related back to capacity. And I wouldn't have thought of this until Nathaniel said that. So I'm glad he did, is you've got to be careful again about going too high on that capacity. If you get higher, it may be more damaging to your credit than not, because you're below in that 30% category. If you go over it, that's not going to be pretty. One, you're going to get feed likely by the bank. And two, if you start dinging past your credit limit, that's not pretty on your score. The other thing I was going to say there too about about really when you can pay your card and how you use it to not have to worry about blowing past that ceiling. If you've got a young utilizer of debt, maybe a good way to handle that we've seen people do is pick out a category that you know can be handled, right? And you can track. So a lot of times people will say gas, but I don't know that people are driving that much right now. So, but you could say, I'm using this credit card only for gas. That does a couple things. One, you don't go hog wild on spending other things and losing that. You can only get so much gas, right? So you kind of keep that in check and it's controlled. And then that way you don't run as great of a risk of getting to those capacity limits or losing the discipline and spending more than you should. That is, of course, always the danger with a credit card, and why it's also a really great indicator for an institution or employer as to how responsible you can be with your money, is because you can get the stuff that you can't pay for, right? That's the whole idea behind it. So it's really a question of being disciplined.
Could you just talk about one or two myths that you think are most prevalent when talking to clients or others about credit cards?
Yeah. I'll come back to the inquiry one because I think there's one that's much larger that we hear from all the time. And that myth is that I have to keep debt on my card in order for myself to build credit. That's not the case. You don't need to do that. And I understand the thought process on that, but let's break that down a little bit. You don't know when the bureaus are going to pull. They don't pull like on the first of the month every month. You just don't know. So they might pull on a day that you have just paid everything off. It's not going to hurt you like that. It's not part of the formula, right? The capacity pieces, but keep in mind, that's actually going to help you, because if you pay that down lower, your capacity, your utilization, as Nathaniel put it, is only going to be better. So that's not something that's tracked. You don't need to keep those balances on there and thus not have to incur that interest and fees. Just pay it off. And I think that people have different habits about that. Some people are just a lot more particular. For example, my wife gets paid every other week, right? Now, Tim, Nathaniel, and we get paid a lot less frequent than that. So I can't do this with myself because she's on a consistent, flow, because she was smarter than me and decided to not be self-employed. Because of that, we can count on a paycheck coming in every other week. Every other week on Fridays, I go in there, I clear out all of the credit card debt on the card. Do I need to do that? No, but I don't run the risk of paying any interest or forgetting, right? So you don't need to keep a balance. That's myth number one that we hear all the time. Myth number two, inquiries. Oh, Nathaniel.
I don't know if you're going to hit this one, but I think it ties into your first point. I want to add on to what Dan is saying about the balance. Your minimum payment does not count as paying off your credit cards. I have heard a lot of people say that. That is grossly inaccurate. The minimum payment does not count as paying off your balance.
Thank you, Nathaniel. I actually wasn't planning on saying that. I'm glad that you mentioned that. And also, just paying the minimum is also not going to get you anywhere. But we can run calculations on that another day. That's an interesting thing to take a look at. To the inquiries. So there's a thought that every inquiry is going to ding your score, right? It's not. Not every inquiry dings your score. First of all, again, soft inquiries aren't going to hurt your score. Hard ones will. However, let's talk about the mindset of the credit bureau again. So there's a grace period, and it's going to depend on whatever bureau is coming into play at that time, however they're going to handle that grace period. It might be 10, 14 days. Sometimes my understanding is it could be as much as 45 days, but we're safe here with 10, right? So that's usually what we recommend. So there's a period of time within that 10-day window then that you can go ahead and apply for credit at different places. And even though the hard inquiry is still going to show up, it's only going to hit your credit score one time. Why is that the case? Because we as in the bureau, right, want to encourage people to do their due diligence and be informed shoppers. So if you're going car shopping, it's not a good idea to prevent someone to go look at another vehicle, another finance structure, simply because it's going to hurt your credit. That doesn't make sense. So you've got a window to go ahead and do that. Where it gets to be a threat is if over a longer period of time, say 3 months, a year, 2 years, a person is constantly getting new cards, new credit cards, constantly going through different vehicles and stuff. That sends a different message to the bureau, which is designed to give information to these lending institutions, right? And the message is this person is not being an informed shopper, but for some reason they're desperate to get credit. Now, granted, I'm not saying that's always the case, right? Nathaniel prides himself on finding the greatest cards and filling his wallet with great cards, right? Daniel's going to get dinged for that if he does it over a course of 2 years. Don't worry, he'll make it back up in other ways, and he'll probably talk about that. But the reality is the bureau doesn't see a lot of Nathaniels, so they have to think about who they typically see in this case, and it's not a good sign. So that's why you get dinged. You're getting dinged as an indicator to the lender, hey, heads up, there might be an issue here with this person trying to get credit, right? So keep an eye of that grace period and don't worry about it hitting every single time. By the way, too, it's not like you get dinged again. New credit's 10% of your score. And it's not like you get hit once and boom, it's gone. You're not losing half your score because you get checked for a credit. It's a couple points if indeed you end up, having your credit pulled on a hard hit.
So we've talked a lot about, obviously, the FICO score, hard, soft inquiries, balances. That sounds like a lot to track. It sounds like there's a lot to go to know, hey, need to pay my balance? What's my minimum payment? So, Dan, how would you go about tracking your score or reviewing your credit? Maybe you want to go buy that car. Maybe you want to go buy that house and you want to see if you're at that 720 limit or that 740 limit, like you mentioned on the high end for that bank. How can you go ahead and take that? And then in addition, just track what you're getting, tracking your score, making sure things are all in place and there isn't any potential errors.
I'll give a couple tips and then I'll yield to Nathaniel. I think he'll do a better job at answering this than myself. But one thing you can do is if indeed you are going to apply for a loan on something, you can ask your lender to see your credit report. A lot of times they provide that and they may or may not show you the score, but they probably will show you the score. They're really not supposed to give you the report, is my understanding still, but you can see it, right? Another piece is that there are, of course, 3 credit bureaus, and you are allowed to request a report from each one of them free every year. You can definitely do that. That's become a little bit of an archaic process now, though, because in all reality, there's a number of services sometimes tied directly to a card, like Capital One uses CreditWise. Or there are services out there like Credit Karma that you can sign up for free and now see all this data. 15 years ago, that wasn't the case. Those places did not exist, and you had to go to one of those 3 bureaus, and that was it. But the world's a little bit different. But Nathaniel's a lot more familiar with that piece of it, so I will shut my mouth and yield to him.
Dan pretty much hit them all. I would just add to the Credit Karma, just to explain a little bit about what Credit Karma provides. It's a very nice format that shows you everything that comprises of your credit score that is being reported from 2 credit bureaus, TransUnion and Equifax. It does not cover Experian, but you can get access to Experian for free through their app if you so choose. Nice to see it all laid out because it tells you how many accounts you have open, what kinds of accounts you have open, what's your payment history on each and every account when that account was opened. You can also see the number of credit inquiries, so what I've generally heard is that if you have 6 inquiries within the past in a rolling 2-year period, you should probably stop before you go further.
And lucky you, Nathaniel, you are up next for my next questions because, like I mentioned at the beginning of this podcast, you are our credit guy when it comes to credit cards within the firm. And I want to talk about what's a factor. Now, I know there's a lot to factor when it comes to picking credit cards. So if I just want to let you run through it, talk about interest rate, rewards, fees, grace periods, acceptability. If you just want to hit on that and explain what you need to consider when looking at credit cards, that would be great.
Sure. So the first thing I'd hit is interest rates. Credit cards have some of the highest interest rates you will ever come across, with the exception of maybe pawn shops or loan sharks. But I generally don't recommend going to either one of those places if you can help it. So don't carry a balance. You carry a balance, you will get charged interest rates of 15 to as high as 30, who knows, whatever the cap is. They put in a cap due to regulation and lawsuits a while back, I think. But regardless, it's insane. 25% annualized interest? That's insane.
So would you even look at the interest rates at all when it comes to credit cards? Like, does it even concern you?
No, it doesn't, because I don't carry balances. I think that what Dan said is incredibly true in the sense that you have to have the discipline to use these credit cards. They are a tool. They are not something to abuse. If you think that you won't have the discipline to pay them off before their payment due date, then you shouldn't be using credit cards at all. And that's okay. You don't have to, not everybody's built to use a credit card. But if you know that you can't use them, then don't use them. So then what I would touch on next is the rewards. So there's different types of rewards categories that one can receive from using credit cards. The types are cash back, points, or miles. I generally don't recommend getting a card with miles because the airlines have shown a history of devaluing their miles over time. So it's generally whatever you're more comfortable with, cash back or points. Cash back, it's cash in your pocket. Speaking for Dan, Dan loves having that cash back versus points because he can use it as a buffer if he wants to build up a small buffer to save for travel, for example, or in 1 month, their car breaks down or something, and then he has that extra buffer there to pay off that higher bill for the month because it's not a typical bill for them. That's just one type of thought. The other type of thought that I've come to utilize over the past 4 or 5 years now. In the beginning, I used to be a cashback fiend. When that American Express cash preferred came on the market, I was sold. 6% back for groceries, hot dog. I was all over that. But then I started to understand the power of playing the points game. And the points game can be very powerful if you know where to look and if you want to put in the time. It takes a lot of time to utilize some of these points games that one can do. I don't really like to do that too much. I like to go for the easy point redemptions and use them. But the reason why I changed to points is because I started to travel more. My wife is from Shanghai. We want to go back and visit her family as much as we can, pre-pandemic, of course. Hopefully when things open up here one day, we'll be getting back on that. But I look at that as a savings mechanism to redeem those points and potentially redeem those points at higher returns, depending on how I redeem them. So there's a lot of different ways you can play that game. It's just a matter of how much time you want to put into it. Or if you just want it clean and simple, you can just go for cash back. You can just go for a flat reward rate for a points card, and then just easily redeem those for travel. Most credit card companies, credit card issuers allow for that feature to easily redeem points.
I don't want to have you go down the rabbit hole too much, but I do think it's important to hit on this question when it comes to the rewards, is the ability to transfer rewards to other partners. I know you talk about that quite often. Could you just talk a little bit about how important that is and how you utilize that system as well? So kind of taking the next step with your points.
There are basically 4 big credit card, what I call ecosystems: American Express, Chase, Citi, Capital One. So those 4 issuers, credit card issuers or banks, they're both, they have established relationships with their what they call transfer partners. So for example, Chase has relationships with Hyatt, Marriott, thinking some of the airlines, United, etc. So you have the ability to take the points that you've earned on certain Chase cards and transfer them. And the ratio differs for each relationship, but generally 1 for 1. But to transfer those points to those partners, and then those points become that partner's own currency, own points currency, that you can then redeem to stay at a hotel or to fly an airline. And that is one of the best redemption methods out there. But the best redemption chance, best return on your redemption is typically transferring to one of these partners, because sometimes you can take that point, if it was say worth 1 cent, and you can sometimes double or triple or even more, if you know what you're doing, that point's value.
really interesting. And so in regards to the rewards, I'm going to kind of take another step forward, is some of these cards that you're talking about have fees attached to them. So annual fees. So at what point, and can you talk a little bit about obviously the fees? And then in addition, at what point does it make sense to start paying for those fees and to have the ability to redeem them through these certain credit card, the big four, like you're mentioning, to be able to do that? You know, the one that people really talk about the most common, that's widely known for a lot of reasons, is like the American Express Black Card, you know, status symbol, great rewards like concierge services. Like, could you just talk a little bit about that and then how that ties into the potential fee that you're willing to pay?
I'm okay with paying fees because when you do, you just got to do the math. You have to look at your spending and you have to look at, okay, if I want to get, say, the Chase Sapphire Reserve, I have that card. That fee started at $450. I think they've now increased it to $550, I want to say. But it comes with a $300 travel credit, which can be applied literally to any type of travel, including parking, taxis, Uber, Lyft, cruise ships, car rentals, flights, hotels, the whole gambit. So if you travel, spend $300 a year on any of that type of travel, it's basically a $250 fee that you're left over with. So if you then do the math on that, let me just get out my trusty calculator here, which just quit on me for some reason. Hold on a second. Okay. So if you then do the math on Sapphire Reserve, it's a 3% rewards category for travel and eating out, restaurants, eating out, fast food. So if you have to spend this amount of money per year in order to break even on the Sapphire Reserve. However, to your point about fees, they
For
come
our
with
listeners,
perks.
that was $8,333.33.
Oh, did it read backward? I can't tell. It looked reversed to me. Was it?
No, it's just that people aren't watching the video. I was just making sure our
Oh, good
listeners
point.
knew. $8,333.33. But I do love your calculator.
Oh, I'm sorry. I'm so used to looking at myself. It's hard to look away. Okay. So yes, $8,333 and change. If you spend above that amount in those categories or whatever you spend on that card, then you're going to break even for the fees. However, this is where it then gets into like, well, what else does the card offer? Some of them offer some perks. Sapphire Reserve is one of those cards. Another big game in town is the American Express Platinum, or as Tim mentioned, the American Express Black Card, which is actually called the Centurion card technically, which offer a number of perks. So the Sapphire Reserve, for example, offers it's included in your membership of the card, which is the Priority Pass Lounge Network. So when you go travel throughout in airports around the world, you can find on this cool little app from Priority Pass to find a lounge that is in their network, and then you can go stay there for free.
Nathaniel, the Sapphire Reserve card from Chase 2, I think I recall you telling me that benefit was extended to other areas temporarily due to the difficulty in travel.
That is correct. Yes. So So Chase and a number of these credit card issuers have come out with temporary benefits as a result of the pandemic, because obviously with the Sapphire Reserve, people aren't traveling as much. So they got to change their game up a little bit. So for example, they decided not to implement the fee increase for their current credit card users. They were planning on doing that at the beginning of 2020. Well, that went out the window as soon as the pandemic happened. So they delayed that. So that was one thing. The other thing that Dan is specifically referencing is that late last year, Chase announced, they said that, hey, that $300 travel credit, you can now apply that to groceries and gas. So that money's, that I'm not even considering that in my calculations. It goes back to the fee, which is now, to me, it is a net 150 or 250. I think it's from when I renewed last year, it was still at the 450 mark. So it's 150 fee for me. And I can easily spend what we're spending on restaurants, fast food, eating out, going to pick up and such, I'm easily spending that amount of money required. And in addition, they also came up with a number of other benefits, like they offered a free Lyft Pink 12-month membership for a year. They also offered the Lyft, I think, some credits for Lyft. Oh, and DoorDash. They offered like $60.
DoorDash.
Yeah, $65, I think, for the whole year. We blew through that in a month.
Priority Pass too. Priority Pass is a big deal with Sapphire Reserve. I don't know if you mentioned Priority Pass.
Yes, I did. Yes, it is a big deal. I've taken advantage of that when I've flown. When Dan and I went to New York the last time for the Liberty Investor Day, we stayed in an airport lounge and we just sat there and caught up on work, and we had free food. I mean, come on, how can you turn that down? That, to me, $150 a year, right? $150 a year for just that one experience is worth it to me. But I want to make that clear. It's worth it to me. It may not be worth that to other people, and that's okay. But I value that because I can sit in a relatively quiet space, get work done, have free food. So it's a matter of weighing. It really comes down to a matter of weighing what you are looking for quantitatively and qualitatively. That's really what it boils down to with the fees.
Nathaniel, I don't know if you saw the outline or not, but you're leading me right into my next questions, which is finding the right fit. And so that's what I want to talk about next is from like, do we need to look at an individual's spending patterns, their habits, or do we also need to start from the high level like Dan mentioned? And he likes to always throw out the analogy. He wants one card to rule them all, similar to Lord of the Rings. Nathaniel, you like to play the credit card game and probably have as many credit cards as you can, or as much as your wife would allow.
Exactly.
Yeah. And so I'm just curious on just talking a little bit about the right fit for an individual. And if you could walk through a little bit of a framework around that process.
You want to, the key point here is that you want to find a card that fits your spending. You don't want to fit your spending to the card you want. I've struggled with this for years. Not because I don't fall susceptible to it. I've had my eye on the American Express Platinum since forever. I've wanted that sucker for years, but somebody won't let me get it.
He's pointing at his wife for our listeners.
Fortunately, she's got her headphones on, so I don't think she can. Maybe she does. She has that smile on her face like she's going to, oh, she did hear me. Crap. She's going to smack me when this is over with. Anyhow.
The answer is still no.
But
And I understand why she's saying no. I totally get it. When we first met, I was all about the credit card game. We literally went to all like the grocery stores within our area, and we looked to find like where the cheapest produce was and the cheapest stuff was. We weren't making that much money then, so I enjoyed this. But then as time went on, I came to understand Ying, my wife's point of view, which is that having all these number of cards, I track these on a spreadsheet that I love to play around with. I track all of our balances. I pay off my credit cards when I get the urge, like could be every 3 days. It could be every week. Sometimes I go a week at a time and I don't pay it. And then I start to get a little itchy and then I got to pay them. You know what I mean? But the problem is that Ying doesn't feel the same. And that comes back to another core point, is that both you and your significant other, your partner, you have to be on the same page with this, or one of you has to be willing to take this on. But then even then you have to balance it out, because if something happens to me, for example, I think I have, I don't know, between the two of us, I think we have at least 8 to 10 credit cards, I think. And that's, as to Dan's point about capacity and credit utilization, our credit utilization ratio, awesome. But that comes at a price, because if something happens to me, then Ying has to go to those credit cards that are in my name and she may be an authorized user on. I think those credit cards would have to be shut down. And as a result, what does that do to her credit? Because if she's shutting down a card that has a long history and she was an authorized user on that, that shows up on her credit history. That could hurt her credit score. So if you do this earning and burning strategy of getting into new credit cards, so you can take advantage of the credit card one-time bonus that you get if you hit a certain spending metric, and you want to take advantage of that huge pool of points, and you keep playing that game, there's nothing wrong with that. But you have to consider the consequences of these actions, because that creates hard inquiries on your credit. That increases the number of hard inquiries on your credit. And then if something happens to you, your spouse, your partner has to deal with that. So that's what I had to come to understand, is that she doesn't want to deal with that. I don't blame her. That would be a pain in the butt. I mean, think of all those passwords for one. I mean, fortunately, we have a password management system, but it can become quite a pain. So you have to balance out all of these factors, think about it, and then execute. For most people find it simpler to go the way that Dan has, which is he's got one card. I mean, technically he has two or three maybe, but he's retained
I
it for
technically have 5, but I have one active card.
Right, and he's retained those other 4 cards because of their credit history. There's nothing wrong with that. He has the Citi Double Cash card. It's a great card. You get 2% cash back on everything. That makes total sense.
So we don't want to give too much away of your secret sauce, Nathaniel. Our listeners need to come and talk to you about this. So don't give up too much information. But it was very informative, and I've taken your advice very thoroughly myself. Just to kind of round us off here, Nathaniel, what resources would you recommend to the listeners and the viewers?
The top one that comes to my mind when it comes to just general financial advice is the Consumer Financial Bureau. This is a federal entity. Go to their website. They will break it down for you when it comes to credit cards. There is, as we love to say, there are no stupid questions, especially when it comes to finances. What is a grace period? What does a minimum payment mean? Should I pay off my balance? They'll help you do that, but so will we. So sometimes it's better to talk to people about it. I get that. When it comes to playing the credit card like points game, there are a number of websites out there. The biggest one that I'm aware of is thepointsguy.com. There's also Million Mile Secrets, 1 Mile at a Time, OMAAT is what it's known as. A View from the Wing. All of these cater to the same kind of content, but sometimes you might pick up nuggets here and there if you want to play that kind of points back game. Other than that, I mean, creditcards.com, Nerd Wallet, those just give general advice on credit cards in general, and then they'll compare and contrast most of the big name credit cards. In some cases, a lot of bank credit cards, like as I mentioned, PenFed or Navy Fed, they'll do some small reviews on that. They'll lay out the basics. Here's the rewards rates, annual fee, credit card, credit interest rate range, etc.
Well, and don't forget you as a resource too, for at least our clients, because the hard part on understanding how to basically have the card fit spending is to understand your spending. But luckily for our clients that allow us to do so, you don't have to look at that because we have the ability to. So Nathaniel dives right in there and takes a look at your spending when we try to fit you and tailor you to the card.
That's an excellent point.
Which is dangerous,
Yep.
but useful.
Yep.
In closing, I think I just want to say that when it comes to your credit, you really do have more control than you don't. You really are in the driver's seat. Just a matter like a lot of things, just knowing where you should put the pieces. And but you can indeed build that score. That is not something that is impossible for most people. You can correct those situations if you have poor credit, or if you don't have credit, or if you have great credit, but you're perhaps wanting to make it better or compete with a significant other. We have people do that all the time. But the important piece, I think, really, besides knowing that you have control, is to really know yourself. And I think that's what a lot of what Nathaniel was saying, not only from fitting a card, but also knowing your habits. This really is about discipline. There are many people that we've spoken to that are intelligent people, and they're smart enough to know themselves as far as, hey, if I have this credit, I'm not going to do good things with it. Great. Kudos for knowing that. You're human. So then don't, right? Don't put yourself in a situation where you're tempted to do something that you know is not a good idea. So, and if indeed you do have that piece under check, then make your money work for you. Utilize the credit, and maybe even to the extent that Nathaniel wants to utilize his credit. And it's almost like getting a part-time job, except for you don't really have to work it.
I thought it was great to see Nathaniel's enthusiasm this whole podcast about credit cards. I say that half jokingly, but the other half of me thinks that this is really what we care about, is we care about finance. And when we say that, finance encompasses a large amount of subjects. But it was great to see Nathaniel, and he really does enjoy this subject, and he goes into a lot of depths, and our clients are very fortunate to have somebody with that kind of resource. I mean, I'm fortunate myself. It's a lot of work to really understand what credit cards work. Some of the transfers, you really have to do a lot of due diligence and a lot of detailed work. And Nathaniel's done quite a bit of that for a lot of different people, which I really do appreciate. The other thing too, is it's funny, we were talking about credit this entire time. And we were talking about debt. And the funny thing is we're not telling you to use a credit card for debt purposes. We were really telling you to use it for a tool, right? And not to use it for what it would seem to be intended for, which is for a loan. I always like to tell people, and I think that this is how everyone should view it, is it's just like a debit card. If you're using a debit card and you have the ability to pay it off and you don't have a spendthrift habit, it is not rational not to use a credit card. It's just irrational not to use it. It just is. Because you're leaving money on the table. It's almost like a 401k match. You want to make sure you get the match so you can get that free money. You want to use a credit card so you can ensure you get that free money, even if it's the double city cash back like Dan uses at 2.5%. That's 2.5% that you can get per year. 2%, sorry, 2% back, 1% purchases and 1% when you pay it off. That's right. So overall, I think that it's extremely important that you really take a look at it. However, just as Dan mentioned, and Nathaniel mentioned very well, if you don't have the ability to pay it off, then don't use it. You really shouldn't, because it's not a good use of debt. If you want to talk about what other uses of debt to maybe fund some expenditures, we can talk about that, but don't use credit cards. Thani, take us home.
But Tim makes an excellent point about the potential returns. It's an easy return on not so much investment, but on your spending. Without even thinking about it, the base returns that I've seen for a cashback card are 1%. So if you're spending $50,000 a year, that's a free $500.
That's better than savings accounts are giving right now.
Thank you. Oh, that's an excellent opportunity cost comparison. Absolutely. So it's easy to do, but you have to know yourself. You have to understand what you're capable of. To reiterate what both Dan and Tim said, you have to consider what your spending patterns are. Do you have the discipline to pay off that balance every month before on its due date or before? If you don't do it. Don't try and fit a square peg into a circular hole. It just doesn't make sense. Weigh the quantitative and the qualitative reasons for why you're thinking about doing this. For me, it just doesn't make sense to go out and get that American Express Platinum card because it's really just about the perks. You're paying a fee for the perks. And we just don't travel enough, even pre-pandemic, for it to make sense for us.
Did you just admit that and put that in stone that you are not going to get the American? I have heard you talk about that for years.
No. I'm talking about now.
Oh, okay.
Ying and I have made a pact that at some point it's just going to be all platinum, and we're going to switch most of our spending to the platinum. We'll keep the other cards open, but But
I can appreciate the communication there. I can tell you that much.
Time will tell. I'll see if I get some negotiation room there. We'll see. I gotta play it just right, because so long as she dies before me, I'm good. I can keep as many cards as I want. So maybe I gotta hedge myself there. I'm working on it though. We'll see how that goes.
Digging
And
a hole.
anyways.
I'm submit that to my life insurance company.
Anyways, I'll end with this. Be rational in what you're looking to achieve with this. Because if it doesn't make sense for you, then don't do it. There's no shame in that. So with that, we'd like to thank you for listening to three guys chatting about what they love. And we will see you next time. Have a good night.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.